The Better Outcome segment today being brought to you by mycdlp.com, mycdlp.com. Moving into an existing rental property following divorce may have tax consequences. The Housing Assistance Tax Act of 2008 was signed into law on July 30th, 2008, and was designed to boost the floundering housing market, providing certain tax breaks for homeowners and home buyers. The act provided new property tax deductions for non-itemizers and offered first-time home buyers credit for purchases. However, one of the most overlooked and unknown changes was the reduced home sale exclusion for years after 2008 for property use as both a principal residence and a vacation or rental property. The new law required homeowners to pay taxes on gains that reflect the portion of time the taxpayer owned a home when it was not used as a principal residence. The remaining gain was available for exclusion, up to $250,000 for single filers and $500,000 for joint filers. Previously, the loophole allowed taxpayers owning a vacation or rental property to live there for 2 years, sell it, then take the full gain exclusion, even though portions of their gain may have been attributable to when it was used as a vacation or second home, not as a principal residence. The Housing Assistance Tax Act of 2008 provides 4 important tax law changes that impact individuals and small businesses. These tax laws are part of the larger Housing and Economic Recovery Act of 2008, which provides a number of laws relating to housing and mortgages. As mentioned previously, one of the highlighted tax law changes is related to prorated capital gain exclusion for real estate for periods of non-primary use. This may be a concern for divorcing clients when one spouse retains a current investment property to be used as their primary residence. Under the Housing Assistance Tax Act of 2008, the IRS now wants its share of capital gains tax during the period from January 1, 2009, up until the property becomes a primary residence. So calculating the potential tax liability. After December 31st, 2008, gain from the sale of a principal residence will not be excluded from income to the extent the property was used for a non-qualified use as defined under Code Section 121B4, as amended by Housing Act Section 3092. This new restriction only applies to non-qualified uses occurring after December 31st, 2008. A non-qualified use consists of any period beginning after December 31st, 2008, in which the property is not used as the principal residence of the taxpayer. To calculate the amount of the gain that is allocated to periods of non-qualified use, the total amount of gain multiplied by the following fraction, the aggregate periods of non-qualified use while the property was owned by the taxpayer, divided by the period the taxpayer owned the property. Non-qualified use, however, does not include any portion of the 5-year period that occurs after the last date the property is used as the principal residence of the taxpayer. For example, suppose John buys a home on January 1st, 2016 for $400,000 and uses it as a rental property for 2 years, claiming $20,000 of depreciation. On January 1st, 2019, John begins using the property as his principal residence. John moves out of the house and sells it for $700,000 on January 1, 2022. John used the property for non-qualifying use for the first 2 years he owned it. The year after John moved out, however, is treated as a qualifying use. Therefore, 40%, 2 out of 5 years owned, or $120,000, of John's $300,000 gain is not eligible for exclusion. The balance of the gain, $180,000, may be excluded. In addition, John must include $20,000 of the gain attributable to a depreciation as ordinary income, unrecaptured Code Section 1250 gain. Non-qualified use also does not include any period during which the taxpayer or taxpayer's spouse is serving on qualified official extended duty, not to exceed an aggregate period of 10 years, nor does it include any period of temporary absence because of change of employment, health conditions, or other unforeseen circumstances as may be specified by the IRS, not to exceed an aggregate period of 2 years. The Housing Act is intended to restrict gain exclusion when an investment property is transferred from a non-qualifying use to a principal residence. The new provisions do not restrict gain exclusion when a property is transferred from a principal residence to a non-qualifying use. Again, this provision only applies to non-qualified uses beginning January 1st, 2009. The moral of the story is that moving into a rental property, maybe primary residence, may carry significant tax consequences. Working with a certified divorce lending professional and incorporating divorce mortgage planning into the divorce settlement may help both spouses obtain new mortgage financing post-divorce. Contact a CDLP today for the Divorcing Your Mortgage Home Workbook. That would be mydymworkbook.com, mydymworkbook.com, a guide to credit, real property, and mortgage planning after divorce. This workbook will help you get organized, be prepared, and understand your mortgage finance position, whether you are needing to refinance the marital home in an equity buyout situation or prepare to purchase a new home post-divorce. As a divorce mortgage planner, the CDLP, that's me, can help divorcing homeowners make a more informed decision regarding their home equity solutions while helping the professional divorce team identify any potential conflicts between the divorce settlement home equity solutions as well as real property issues. That is my CDLP. That is the Better Outcome segment brought to you by mycdlp.com. Again, the Better Outcome segment brought to you by mycdlp.com.